Hi, welcome to Chapter 17, Bond Yields and Prices. So, in this chapter, we're going to talk about, of course, bonds and the calculation of certain bond values. Now, most investors will recommend that, there should be some portion of your portfolio in bonds. And bonds are an attractive investment. You get interest on your principal, and you get your principal paid back at the end of the bond's life. Now, these predictable cash flows are good because these are income that you could use for retirement, income you could use to invest in other investments as the bond matures. And you have the ability to preserve your capital above, basically, when we say preserve your capital, we mean that you're getting a return above inflation. So when when you have a portfolio, including bonds, it's good for stabilizing lowering your risk and stabilizing your return over time. So there are many important advantages and disadvantages of bonds that we'll talk about during this chapter. And as far as risk and return, the fundamental characteristics about bonds are different than stocks, so that's why it's good for diversification. So how do, when we look at bonds, in this chapter we'll talk about, bond features like the coupon rate, the time to maturity, callable bonds, the risk of bonds, and to be, a successful investor, you need to understand some of these basic issues and definitions of bonds. So when I go through this presentation, I'm going to talk about the analysis of bond prices, different bond participants, various yield measures, unique aspects of certain bonds, potential returns to investors. So we're going to focus on during this presentation is how bonds are valued, how bond features impact bond prices and returns, and how bond prices change over time in relationship to yield curves. And a lot of the bond value calculations I'll be doing in Excel as the chapter progresses. Now, let's move on to the next slide. So we need to talk about interest rates because interest rates are the most important component on bond valuation and bond measures. Now, oftentimes you'll hear in the news, they'll say the Fed raised interest rates 25 basis points. And many people don't understand that the basis point is just 1% of 1%. So if interest rates rise 1 percentage point, it's actually what we would say is the interest rate rose 100 basis points. So 50 basis points would be a 0.5% increase in interest rates. So that's just part of the jargon for bonds, as we say, instead of saying the full percentage term, we use basis points. Because a lot of times interest rates will rise at a small fractional. We'll say 10 basis points because it's just easier to quote things in basis points than the full percentage changes. So now when we talk about a riskless rate, that's a foundation for all other rates. So if we look at a 3 or 5 year treasury, we can kind of say that that's a riskless rate of return, meaning that there's no risk that won't be paid back because it's a short maturity and it's backed by the federal government. So when we talk about risk-free rates or riskless rates, we're basically aligning that the closest instrument to what that could be would be a treasury security. So other rates that, could differ because of maturity differences. Some bonds mature in 5 years, in 15 years, 30 years, 100 years. Yeah, there are 100-year bonds. It's crazy, right? And it's also security risk premiums. How secure is the bond? So things like that are going to factor in. But interest rates, by and large, are going to be a huge factor in the valuation of bonds, in the changing of bond prices. And there's this inverse relationship. As interest rates rise, bond prices decline. And if interest rates decline, bond prices increase. So interest rates are very important in the world of bonds. I mean, interest rates are also important in the world of stocks because typically if interest rates rise, stock prices go down too. And if interest rates go down, stock prices generally go up. But there's a more of the timing is very different between stocks and bonds. Bonds are almost an immediate impact with the change of interest rates, where stocks can take a while before these changes of interest rates are fully integrated into the effects of the business cycle and then therefore the effects of stock prices. So the opportunity costs of, basically if you invest your money in a bond, there's an opportunity cost where you're not going to be able to put that that money into another investment or that money into some kind of consumption. So interest is going to compensate us for part of that opportunity cost. Now, the real risk-free rate is going to be the real rate unaffected by price changes or risk factors. So that means unaffected by inflation or other risk factors. So the real risk-free rate means that a rate where there is no risk of default so this is something we'll be exploring in this chapter a little bit. Now, the nominal rate and then the risk-free rate includes a real component or the real rate. So we're going to also put that in with expected inflation. So if we look at here is the risk-free rate. So if we take 1 plus the real rate component times 1 plus the inflation rate minus 1, we can calculate the risk-free rate. Now, so risk-free plus the risk premium is going to be what the interest rate is. So we'll just let R stand for interest rate. So this particular formula is going to encompass all of the rate is going to be broken up into these two categories: risk-free, which we consider, say, a 3 or 5 year treasury, and risk premium. So the RP, this risk premium, is going to be associated with the time, the maturity in the bond, the liquidity of the bond, the credit quality of the bond, and that's all going to be built into this risk premium. So this is a premium of risk that we think the bond could be facing in the future, and we need to add that to the risk-free rate to get what our required rate or the rate of return would be on the bond. So those are just some semantics of when we look at bonds, understanding that we could break the interest rate up into different categories to express what part, because think of it this way: what circumstance would you not want extra compensation if you're investing in anything with extra risk? So if you invest in a 3 year treasury, there is no real risk, so that's your risk-free rate. But if you're going to invest in a corporate bond or any other type of a bond that's going to have additional risks, then you need to have additional interest rate to compensate for it. So there's a big relationship between time to maturity and yield to maturity. So time to maturity is really how long before the bond matures. So you could have a 30-year bond. It could be in its 14th year, which means there's 16 years left to maturity. And then the yield to maturity is going to change because the underlying bond prices, just like stock prices, change every day. So there's an ability to pick up capital gains or capital losses on the bond that we can factor into what we call the yield to maturity. Now, if we plot these different yield points on a map, we can develop a yield curve. So this is going to be, a visual relationship between yield and time that we can see on a chart to give us an idea of where these bond prices are moving. Now, of course, default risk would be held constant when we're looking at these charts. And this is a relationship that we can help predict the movement of stock prices even. So if you have an inverted yield curve, that's one of the predictors of stock price changes. So if we're looking at this term structure of interest rates, we could have what is most common would be an upward sloping yield curve. So this is what we see most of the time is this what we call an upward sloping yield curve. And this is where interest rates rise with the length of maturity. And this makes sense to most people. So if you're going to if it's a bond based on, say, the same company, whatever company that might be, Coca-Cola, Disney, Amazon, if the bond's going to mature in 5 years, you'd expect a lower interest rate than if a bond's going to mature in 30 years, because there's a lot more can happen in 30 years than 5 years. So that's why we see this upward sloping yield curve for different time to maturity on a similar corporate bonds, or even. But when we do measure the term structure, we typically use government treasuries in different positions, 3, 5, 10, 15, 30-year treasuries, to look at how the different interest rate positions are in that time frame. Now, a more unusual state of the yield curve would be a downward sloping yield curve, which we see in the stock investing area as a predictor of recession, because these downward sloping yield curves have predicted a number of recessions pretty accurately. I think over an 80% accuracy rate. So the market gets really freaked out when you see a downward sloping yield curve. And in 2019, they developed downward sloping yield curves developed, and typically they say within 6 months the stock market will decline. Well, sure enough, 6 months later, the stock market did go down 30%. Now, the downward sloping yield curve didn't predict the reasons why the market would go down. It's just a general economic condition that leads to, is a predictor. It doesn't actually directly lead to, but it's a predictor of stock market declines. And there's usually not 100% scientific reasons why the market declines. It's just sort of an indicator that can't be completely tied to reasons why the market declined. So the market declined in 2020 for reasons that were completely unpredictable. However, it still added to the predicting rate of the downward sloping yield curve. And that's when short-term rates are higher than long-term rates, which is not a typical position that makes much sense to investors, but do occur when the Federal Reserve increases short-term rates and long-term investors feel the economy isn't going to really be doing, or inflation isn't going to be a problem, or the economy isn't going to be heating up too much in the long term. You can see longer-term rates not really react much to the short-term rates increasing. So that's usually this downward sloping yield curve occurs when the Fed raises interest rates. But typically, in the past, if the Fed raises interest rates, the economy does slow down, and when the Fed lowers short-term interest rates, the economy does increase. So it makes sense that the change in this downward sloping yield curve due to Fed action affects the economy. So it's probably the most direct link. Now, there is a term structure theory that helps explain the shape of the yield curve. So when we look at this, term structure, we have a couple of things we can kind of talk about. Well, one is, the basics of the expectation theory. So a term structure is what we call, as far as how we look at the different aspects of the yield curve in years. So so the average expected return of holding a series of short-term maturities over the same period compared to a longer term, we would expect to see longer term instruments have higher rates than shorter term. Now, if that's the expectation, then there's going to say that the yield curve will start to mimic that. So it's sort of like a self-fulfilling prophecy. If investors expect short-term rates to be higher than long-term rates, then they'll see an inverted yield curve. So the expectations theory is really just looking at saying that whatever investors expect, they're going to make trades on those expectations, and then those expectations will come true because they're trading on it. Now, the liquidity preference theory would state that investors prefer more compensation for less liquid positions. So shorter term securities are considered more liquid than longer term securities. So this liquidity preference means that we should generally see an upward sloping yield curve, and for the preference of liquidity, which basically means, what is liquid? So a bank account is very liquid, money market is very liquid. Stocks can be liquid because you can sell stocks pretty quickly. Houses are less liquid. So this liquidity preference, we're pretty much talking about time to maturity. So we consider things that have, and also bonds that are more easily sold and traded, which are more liquid. We expect to have a little bit less compensation. If there are bonds that you can't easily move in and out of the positions due to low trading activity, that would be a less liquid position. We expect higher interest rates on that. As another example. So there are different reasons. None of these reasons have been 100% proven to be true. It's just theories of why we have these different term structure of interest rates over time. So we have something called forward rates, which are what we would say unobservable rates expected to prevail in the future. So because they're not observable, they have to be estimated from longer term bonds. So we could, using the formula below, we can estimate what the forward rates would be based on information we currently have today. For example, the rate on a 3-year bond is an average of the current 1-year rate and the expected forward rates over the next 2 years. So the same principle holds for any number of periods. Therefore, the market rate of any maturity can be expressed as an average of the current rate and the application forward rates. So technically, the average involved is a geometric rather than the arithmetic average. And that's basically what we see in this formula down here. Okay, so let's talk about the pure expectations theory. So this is long-term rates are on average of current and expected future short-term rates. So no other considerations matter in this pure expectations theory. So according to the theory, forward rates derived from the current longer-term rates equal expected future rates. So the theory is not that forward rates will be correct. No one's saying they're going to be correct because they're an estimate, but there's a relationship between them and the current rates. So if the forward rates are moving higher compared to the current rates, we expect rates to go up in the future. If the forward rates are lower than the current rates, then we'd expect interest rates to go lower in the future. But no one expects that those forward rates are 100% accurate, and then that's where the rates are going to actually end up at some period of time. It's just an indicator or a sign pointing to where interest rates are going up or down compared to the current rates. So what the yield curve tells us, as I was explaining before, is upward. Investors are expecting interest rates to increase, generally meaning the economy is going to increase as well. Downward, investors are going to expect interest rates to drop, and that's going to be related to a declining economic activity. And flat, investors expect interest rates to remain constant. So flat would be when the current rate is very similar to the long-term rate. So we could say a 5-year rate of interest of 3% is very close to a long-term rate of 3.05%. And this, again, usually occurs with most of the downward and the flat yield curves occur due to Fed interference in the short-term funds market. So when the Fed isn't really active or the Fed is leaving interest rates more neutral, we'll see this upward sloping curve most of the time. So this is what we could basically read into the changing of these interest rate curves over time. Now, like I was explaining before, the liquidity preference theory, this is where our expectation is that future rates are going to be higher because of the lower liquidity due to the time it will take for the bond to mature. So, of course, the interest rates are going to reflect the current and expected short-term rates, and those expectations theories are going to, add to the fact that longer-term positions or longer-term bonds have a risk premium. So the uncertainty around the increase in time, especially, on the longer end, the 30-year end, investors generally are going to prefer a shorter run bond at a lower interest rates because of the lower risk. So if investors prefer to borrow in the longer run, it's in order to gain additional interest, which they're giving up some liquidity to obtain that. So if we want to talk about the difference between the liquidity preference theory and the expectations theory, we have to recognize that interest rate expectations are uncertain. So risk-averse investors need to be compensated for this uncertainty. So the longer-term bonds, you need more compensation. So the forward rates and estimated future rates are not the same. They differ to the amount of liquidity preference. So what we're saying here again basically is that investors, if they're going to take on additional risks that are going to limit or lower liquidity, they're going to need additional compensation. So longer time horizons will increase the uncertainty of interest rates. And that's going to mean that longer term borrowers would prefer higher rates for the lower liquidity, higher risk than short term investors. So this liquidity premium is, needed to induce people to buy the longer term securities. So if you have a choice between, just think of something, you may be familiar with CDs at the bank, certificates of deposit, and you know that the longer your money is locked up at the bank, the higher interest rate they give you. So you wouldn't buy a 5-year CD at a lower rate than the 2-year CD. So your liquidity preference, meaning that since you can get your money in 2 years out of that certificate of deposit, you would expect a lower interest rate than if it was a 5-year CD. So that's all the liquidity preference is thinking about. That's how investors expect it to be, and it does compensation based on how long their money will be in the investment. So pretty common sense to understand that. Now, the preferred habitat theory. So market participants have preferred market segmentations. So basically, short term, intermediate term, and long term would be the three big market segmentations. And most investors don't want to move out of those segments. So if you're a longer term investor and you invest in long term segments, you're not going to. No one's going to convince you to sell your investments and move them to intermediate or short term too easily. So this market segmentation theory is saying that each of these segments, short, intermediate, long-term bonds, have their own supply and demand characteristics that independently determine what their interest rates will be based on supply and demand, the buying and selling of the bonds in those different segments. So this would just basically say there's no real, continuous 30-year segment. It's broken down into three smaller segments that have their own specific supply and demand curves that are going to set the interest rates for those segments. And that's how the yield curve is going to be established. So that's just another theory to talk about. So let's talk about the yield spreads. Why other reasons that result in differences in yields between different bonds. So things that we want to look at, of course, is going to be the quality of risk of default. So some bonds are going to have a higher risk of default than other bonds. And we can look at a bond rating agency like Moody's or Standard & Poor's that will rate bonds based on their quality. So bonds with lower quality, meaning more likely to be defaulted on, will have to have additional compensation to investors in the form of higher interest rate. So that's a really big consideration, is the risk of default. Now, differences in time of maturity, of course, the longer time periods, you're going to have a greater amount of uncertainty and you should have a higher risk premium or a higher yield. Differences in call features. So a call feature is when basically it's like a corporation refinancing its debt, or it's like a homeowner refinancing its mortgage. So interest rates go down, you want to refinance your mortgage at a lower rate. So if interest rates go down, a corporation can do what they call a call the bond back, pay off the investors, and reissue a new bond at a lower interest rate. So you as an investor, it's a risk if somebody calls your bond, you have a bond that pays a nice 15% interest rate, and then they want to buy that bond back, pay you back for it, and then reissue new bonds at 5%. So that's a risk. So if a bond has a call feature, meaning that there's a feature that allows the bond to be called back early, this is going to change the risks of the bond compared to bonds that aren't able to be called back early. or if the bond has a specific price called the call price at which the bond can be called and has to be paid a certain price. So these all will affect the risk premiums and the yields of these bonds. Now, as far as corporate rates, bonds with low coupons will pay a higher part of the yield to maturity in form of capital gains. So looking at the capital gains, that's a position that's going to also affect yield rates. The differences in marketability. So some bonds are more marketable, more desirable, and more liquid than other bonds. So some bonds just have a better story. Maybe they're a municipal bond, or maybe they're a bond that's for a very successful company, or maybe they're a bond that's going to have some revenue attached to it, like a bridge with a toll on it. So they're going to be sold more quickly, and the price concessions will be made that could lower the rate of return on these bonds because they're just more marketable, more liquid. So the differences in tax treatments, if bonds are taxable or non-taxable, like municipals are non-taxable, and U.S. Treasuries are U.S. are state tax-free, and municipals are both state and federal tax-free, and sometimes city tax-free, depending on the bond. So those are going to have, if they have a tax advantage, it's going to lower the yield as well. And differences between countries. So countries will have different risks and different political risks, different economic risks, so their bonds will have different yields as well. So other things we can think about the business cycle. So if the business cycle is going to affect inflation, that's going to have an effect on yield spreads as well. So these are all things that can affect the risks of bonds and therefore result in different yields over time. So let's look at the credit spread and default premium. So we're going to use, this is the 10-year Treasury bond through time from 2006 to 2018, and then the BAA bond, which which is a bond that's not a top bond as far as AAA or AA bond, but it's sort of a corporate bond level that, if we look at the yield over time, notice that there's a big spread between the 10 and the BAA corporate bond. That's because there was some financial distress and a recession. So the spread got bigger. And then notice here that the spread got smaller during an economic expansion or where we saw corporate risks were lower. So we can look at this relationship, the spread between change between the corporate bond and the 10-year Treasury over time, and we can see that at different times it widens and at different times it narrows. So sometimes we will refer to this credit spread as a default premium. So it's one of the most popular yield spreads to look at. So this credit spread reflects the difference in yields between low quality bonds, the corporate bonds, and higher quality bonds, say the Treasuries. And we can look at the spread, the difference between the two at any particular point in time. So the credit spread commonly widens during periods of economic uncertainty when investors become more risk adverse. And then it's going to narrow during economic expansion because investors feel that the risks are lower, that corporate bonds will default when the economy is good. So this credit spread, we can see that 2008, the big spread there due to the financial crisis. And this is, it's going to narrow as the economic or the recovery takes place. So this is just basically a good way of seeing what risks are built into the system and measuring the overall feel investors have for corporate default versus Treasury. So this is a nice thing to look at. So one way you can measure this is as the risks start to increase. The spread starts to increase as a result of the risks. Like you could see here, this starting to increase. That might be a sign to sell your stocks or your corporate bonds as this trend continues. When it starts to reverse, and you can see here, hopefully you get it, you would sell around here, maybe buy back around here, because it usually moves in some sort of momentum or trend. Generally, after a big recession or downturn is a good time to get into corporate bonds, as the overall risk will lower, and as this risk and interest rate yield to maturity lowers, the premium of the bond will increase. Okay, here's some ratings from we have two systems, S&P and Moody's. They're very similar system, and they almost look like a grading system in a college. But you know, there was big grade inflation here. So instead of an A being the top grade, you can get a double A or a triple A. So triple A would be the highest rating, and Moody's has uppercase and lowercase letters, but pretty much they're about the same ratings as you move through. So your junk bonds, your speculative bonds, start to creep in around the BB level, and the junk bonds, really junky bonds, would be at the C level. So this is just, independent rating agencies that will look at different bonds and place a rating on them to help investors understand the risks. Okay, so measuring bond yields. So here we want to look at how can we mathematically measure the yields on bonds. So we want to look at the premium bonds with premium prices, bonds with discounted prices, and the different interest payments. So these are different variables. We have to look at the premium, discount, interest payments on the coupon, how often the interest is paid, whether most bonds are semi-annual, some could be quarterly and some can be monthly. Like generally mortgage bonds are monthly. And we want to look at the credit, the current yield. What is the bond currently yielding? It's not the coupon price or the interest rate on the bond. It can yield above or below that depending on the premium or discount. So we want to have a formula. One formula we want to look at is called yield to maturity. So this is the most commonly measured calculation, something I'm going to be showing you in Excel in a minute. And this is going to show us the return we're going to receive from a bond at the point we purchase it. So if we purchase it at a discount or a premium, that's going to be factored into the maturity, and the coupons reinvested at the yield to maturity rate. So it's going to show us, what the overall yield would be if we invest in a bond at a certain particular point in time. So this is the basic formula that we use. I'm going to show you how to calculate this in Excel, which is a much easier way. So there's another way of looking at the yield to maturity. So some bonds can be callable, so we have a separate formula if there's a call price in a yield to maturity. So a call price is when a bond in its contract says that bonds can be called back. Maybe you bought the bond at $1,000 par, but they're saying if they call the bond, they'll have to pay $1,100 for the bond as a call price. So here's a way we could calculate the yield to maturity with a call price. Then we have the realized compound yield. So this is going to be the real rate of return of it, which actually earns. So the yield to maturity isn't a real rate of return, sort of like an estimate. So the realized compound yield would be a more closer to what you're actually receiving. So it's the reinvestment of the coupon at various rates. So this basic formula is what we could use to calculate the realized compound yield, which is almost never the same as yield to maturity. So this is another interesting way to calculate the value of a bond. All right, so let's talk about reinvestment risk. So when we talk about reinvestment risk, we have to remember that the yield to maturity calculation is going to assume that the investor reinvests all of the coupons at the same rate as the yield to maturity. So the interest you're going to earn on your interest is the same as your yield to maturity the day you buy the bond. Now, it's not realistic to think that the income earned at the reinvestment rate is going to be same as the yield to maturity rate. Now, if an investor does reinvest all the coupons at the rate that's going to differ from the reinvestment rate, the realized compound yield will differ from the yield to maturity. So the fact that the coupons almost always are reinvested at a rate higher or lower than the compound yield to maturity, this is what gives us this reinvestment risk. So basically what we're saying here, if you buy a bond that's discounted, you may have a high yield to maturity, say 11%. But if the coupon is at 10%, your actual interest that you're going to be receiving is at 10%, and there's no guarantee you can reinvest it at a level of 11%. So there are points where you might be able to reinvest it at a higher interest rate or a lower interest rate, but this is a risk, which we call the reinvestment risk, because you're not really sure when you get the interest on these bonds at what interest you can reinvest that at. So this risk of future reinvestments is, we're worried about, we're primarily worried about being reinvested at a lower rate than the yield to maturity. So a bond's total return is going to consist of three components. We're going to look at the coupon paid on the bond, the interest rate, the interest income from the reinvestment of the coupons, and the maturity value of the bond, which is assumed to be a par value of 1,000 for pretty much all of our problems. So again, this reinvestment risk is the idea that when you do earn money interest from your bonds, you won't be able to reinvest at the rate at which you enter the bond or its yield to maturity. Now, reinvestment is a critical piece that this income you make from these bonds you want to reinvest. So increase the coupon is going to be a critical factor in how we calculate this. So for longer term bonds, the coupon, the interest on the coupon is going to be more important than, say, a shorter term bond. Now, a zero coupon bond is going to eliminate the reinvestment rate risk because there is no interest or coupons paid. So let me explain what a coupon is. Long time ago, before computers and electronic transfer of funds, when you bought a bond, you got a book of coupons, and you would rip out the coupon for that period, bring it to the bank, and you get interest based on this proof of coupon. So a zero coupon bond means that there were no coupons. It's like a savings bond. You buy it for $50, and when the bond matures, you cash it in, you get $100. So you get all the interest up front at the end. So when we do a horizon return analysis, we're going to look at the bond returns based on the assumptions about the reinvestment rates and the yield to maturity at the end of the investment horizon. So we just have to kind of keep those in mind when we make these calculations. Okay, so let's talk about bond valuation. So this is something that we're also going to calculate. What is the value? I currently hold a bond. What is the value of it today? So here we're going to think back to time value of money. So the value of a bond is related to the present value of its cash flows. So if we're going to calculate what we call the intrinsic value of a bond, we're going to need to know the expected future cash flows, the timing of those cash flows, the discount rate or the required rate of return by investors. So we're going to use all those factors in a basic modification of the time value of money formula, which we're going to call bond valuation. So the value of the bond will be these factors into this basic formula, which we're going to show you how to calculate in Excel. So it's all one aspect that's difficult is determining what the discount rate is or the required yield. So that's it's an estimate that we're going to calculate what the required yield is, but that can change over time. So the required yield, we're going to look at it as the current market rate earned on a comparable bond with the same maturity or the same credit risk. So we have a point of reference, but we have to keep in mind that does change on a daily basis. So now, like stocks, you got to remember that a bond is issued, say, at $1,000 is born at $1,000. But over time, that price, the value of that bond is going to change like the value of a stock price from the day after it's born until the day it matures. Now, when it matures, it's going to mature at that face value. You get that $1,000 back, but along the life of that bond, the bond price will move up and down depending on its inverse relationship to market yields. So this inverse relationship means that if my current bond is going to be compared to new bonds, and the new bonds pay a higher rate of interest, my bond has to be discounted to make it comparable. So the yield to maturity is similar to the newer bonds at a higher rate of interest. So longer term bonds, of course, will fluctuate more than shorter term bonds because there's more periods of interest to be earned, and it's going to have a higher volatility compared to the shorter term bonds. So the change of bond price is going to be related to the change in the current yield prices. So time to maturity and that inverse relationship to the coupon is what's going to set these bond price changes. So here, if we look at a bond, this is 1 year to maturity. So if the par value is $1,000 and the bond's going to mature, it's going to mature at $1,000. But if we have 5, 10, 15, 20, 25, 30 years until maturity, this amplification of the bond price, this is 1,000, we'll say this is 11,000, this is 9,000. We can see a bigger swing in the actual value of the bond price over time, because there's a longer time where the interest difference between what your bond pays and what the market is paying is going to be amplified. So basically what we're saying is, think of you have a 2019 car model brand new, and then you have a 2020 car model brand new. There could be both started out at the same exact price, but when the 2020 model comes out with newer features and more as far as resale value is higher, the 2019 model is going to have to sell at a discount. So if they both started out at $30,000 being a new car, once the 2020 models come out, the 2019s may have to sell at $28,000, $27,000, take a value reduction because the new cars are better. So if new bonds come out at a higher interest rate, we'll say that those new bonds are better because they have a higher interest rate. If it's the same, based on the same company, it's a corporate bond based on the same company, and your bond is paying 8% when the new bonds are paying 12%, your bond is going to have to sell at a discount like that last year model car to make it comparable, to make up for the difference in the perceived value. And that's why bond prices will fluctuate. Now, if we look at the bond price relative to the yield, here is the price of the bond. So as the yield decreases, so the yield goes from 10% to 6%, the bond price is going to go from 800 to 1200. So if we start at a par value of 1,000, the bond is born at 1,000, and the market yield and the yield of the bond are equal, we're going to have a $1,000 bond. But if market yields go up to 10%, new bonds are paying 10%, your bond's going to have to sell at a discount. But if new bonds are coming out, interest rates are declining, and new bonds are coming out at 6%, your bond is currently paying 8%, is going to sell at a premium to make it comparable to the new bonds at 6%. So this change in bond prices is going to change your overall total return, because when the bond matures, you're going to receive a capital gain or capital loss. So if you buy the bond at 828 and sell it at 1,000, that's a capital gain. If you buy a bond at 1,200 and it matures at 1,000, you're going to have a $231 capital loss. So those basically will compensate for the change in interest rates. Based that profit or loss is going to be the difference between what you're receiving in additional interest or not receiving an additional interest compared to the market. Okay, so what does this mean for investors? So if you anticipate a rate increase, bond buyers should purchase low coupon bonds with long-term maturities to get the maximum benefit. So if interest rates are going down, buy those longer term maturities. If interest rates are expected to increase, you want to consider bonds with larger coupons and shorter maturities. Those will be more valuable or hold more of their value. So this is why the way the bond market works closely to interest rates and the current yields in the market. If the traders anticipate certain changes in the market moving forward, they're going to thereby change their positions in their bonds to accommodate. Okay. So let's move over to Excel to do some of these calculations in Excel. So here is my Excel sheet, and here's the bond. So we're going to look at the bond value. We're going to take three occurrences. So we have a coupon rate at 10% and a required rate at 10%, required rate of return. And then what happens if the required rate goes down? So we can use the present value function, which I have a little note here. So I'm going to go and I'm going to call up present value. And for this first problem, I'm going to use the required rate of return as my rate. N per is going to be the number of years. Payment is going to be the coupon payment. So $100, basically 1,000 times 10% is the coupon payment. And then the future value is going to be $1,000 because that's the par value, what it will retire at. So if I calculate this, I basically get a bond value of, now it shouldn't be a negative 1,000. That's just because that's how Excel calculates the present value. So if I, no, I guess let's see, so this just means, it doesn't mean a negative 1,000, it's just because it's a present value. That's how Excel calculates a present value. If you don't like that negative, you could just say multiply by -1, because most any textbook or any problem would want the bond value to be a positive number. So bond values are never negative, but present value calculations will calculate it as such in Excel. Now, if we look at a bond, so this, of course, the bond value is going to be equal to the par value if the coupon rate and the required rate of return are equal. But what happens if the required rate of return goes down? Now, remember, we said bonds have an inverse relationship. So if interest rates are going down, bond value should go up. So let's calculate this now using that same present value formula. Okay, so we see that the bond value goes up. So now if we discount it even further down to 7%, we should see the bond price go up even more. All right, let's try that again. Put it in the wrong cell. And here you can see that it jumped from 1,000 to 1,200 as the interest rate went down. Now, if the interest rate here, when we do these calculations down here, you may want to pause the video and try this yourself, but we see that interest rates now are increasing. So we'd expect the bond prices to be lower as an inverse relationship. So pause the video and see if you can calculate these by yourself. And then start the video again, and I'll show you using that same present value. Required rate of return is the rate, N per is the number of years. Now these are annual bonds, not semi-annual, so the payment and the future value. And at the end here, if you multiply by -1, you can change it to a positive number. So yeah, we'd expect this to be 1,000. And I can actually just drag this over since it's going to be using the same inputs. And we see that we go from 1,800 to 700 as the interest rate increases, thereby proving that inverse relationship. So that's how you would calculate the value of a bond. Let's go to yield to maturity. Now here I have a note to use internal rate of return function, and this will calculate the yield to maturity, which is basically assuming that we're going to reinvest the interest at the rate of the bond, and we're going to find the present value of all the cash flows. So you notice here cash flow year 0 is negative because that's a cash outflow. So here if we use the internal rate of return function, we just have to highlight all of the cells from year 0 to 10 and hit done. And we get 8.77% is the yield to maturity. So pretty simple to calculate that. So I'll give you a chance, try to calculate that in this second example yourself. Okay, so again, we use that internal rate of return function, highlight everything, done, and it calculates the yield to maturity. Now, another way to calculate yield to maturity is we could use the rate function. So let's call up, search for the rate function. And I prefer to use this formula builder because it's easier to assemble the formula than to do it longhand in the formula bar. So here N per is going to be the yield, the year to maturity. Payment is of course the coupon payment, which is 10% times the par value, which is 100. The present value is the current bond value. So this is selling at a premium because it's above 1,000, which is the face value. And then the future value is the bond par value. Okay, done. So this bond yield to maturity is 877. So if you look up here, you see this bond. This is the present value of the bond. The bond pays $100 a year. In the 10th year, you get the par value back plus the last year's worth of interest. So this yield to maturity problem is identical to this, but it's just laid out differently. So here we're using the rate function rather than the internal rate of return, but we get the same result. So why don't you try that on the next two problems and pause the video, try it, and then when you restart, I'm going to show you how to calculate it. Again, we're using the rate function here to calculate. So N per is the number of years. Payment is the coupon payment. Present value is the bond price. And this one's selling at a discount. And future value is the par value. So here when we calculate the return, we see that our yield to maturity, our bond yield to maturity is higher than the coupon. Is what you get when a bond is selling at a discount. And here, where the bond was selling at a premium, you get a rate of interest, yield to maturity lower than the coupon rate. Okay, and the third problem, I can actually just do a shortcut. I can copy that and put that down here. So this is basically if it's going to sell at a premium of $1,500, a 10% bond is going to be a yield to maturity at 3.7%. I'm just going to recalculate that to make sure. So N per is 10, our payment is 100, present value 1,500, future value 1,000. Yep. So because, again, following that same, if this is going to sell at a premium, then just like here where this was selling at a premium, we expect our yield to maturity to be lower than our coupon rate. And since this is such an extreme premium, 1,500 compared to 1,000, our yield to maturity is much lower. And the reason for that is when it yields, we're only getting 1,000. So we're losing that 1,500 we were buying it at compared to when it matures. We lose that $1,500. Okay. So most bonds are going to be valued in a semi-annual basis, meaning you're going to get your interest twice a year. So what we're going to call this is M, or a frequency of M here. So we're going to calculate the bond value. We're going to use the present value function, but we're going to do it in a semi-annual state. So we're going to take the rate, the coupon rate, the required rate of return, and we're going to divide it by the frequency. Then we're going to take the N per, which is the years to maturity, and we're going to multiply it by the frequency. Payment is going to be the coupon payment. And now remember, this is 50. So basically, it's going to be 10% times 1,000, which is 100 divided by 2. So the coupon payment is only 50 every 6 months. And then the future value is 1,000. So when we calculate this, we get a bond value of 885. Now, what if we calculated this as an annual, not a semi-annual? So if we did that, let's see what the rate difference would be. So the rate would be 12%, N per would be 10, payment would be 100, and future value would be 1,000. So here we see the difference is about $2. Okay, and that's to do with the compounding because it's every 6 months, not every year. So try these next two problems yourself. You can pause the video and try them. So you can see here that this bond is selling, the required rate of return is 8%, so it's going to be at a discount, should be at a if the required rate of return is 8% and the coupon rate is 10%, the current bond value should be a premium because the bond is yielding higher than the required rate of return. And in this example, where the required rate of return is 14% compared to a coupon of 10%, we'd expect the bond to be selling at a discount to make up the differential between what's required and what the bond is producing. Okay, so those are just some calculations on how to value bonds in Excel that's related to the work in the chapter. Thank you for taking your time to listen to this video to the end, and I hope you found it helpful. At this point, it might be useful to read the chapter and review some of these concepts. Thank you.